we're in a multi-year bull market here. In 2000, silver was around the $5 mark, ran to over 50 to over 10 times. Now we've gone from this channel of 4 times, 5 times, that could be 80, 100, or even more.
When you look at the fundamentals that drove the silver price to $100, are they still intact to drive the silver price to $300 and perhaps beyond?
Well,
gold and silver have been some of the best performing assets in the last year, and in fact, the last 2 years. Silver in particular is up 77% from exactly a year ago, and that's today's prices. It already pulled back almost 50% from its highs earlier this year. Jim McDonald, CEO of Kootenay Silver, is one executive who's been calling for silver's direction to go up, and not only has been correct, the momentum has surprised even many silver bulls. So we'll get his take on why silver behaved the way it did in the last half of 2025, why there's been a pullback now, and what the mining is doing right now since the price has been consolidating around $70 an ounce. Welcome back to the show, Jim, and congratulations on not just the success of your company, but the success of the silver industry overall. Exciting times for everybody.
Yeah, David, good to be here again on your show, and a very exciting time. I mean, yes, a year ago, I think it was about $35 silver, and now, of course, today we're trading at about 64, 65, having seen it run all the way to 120. This is something that we foresaw, if you will, or certainly believed in for a long time. The gold price had broken out and taken off is after being in basically a bear market for almost 10 years. And a year ago, silver hadn't really responded yet. And when it did in spectacular fashion. It's something that a lot of people who've seen a few cycles know that when it does go finally, it goes in a very aggressive manner. And we've seen that. Now, everybody can see that and refresh their memories, or people who have never looked at this silver market before. Of course, it changes a lot of things. So our belief here is that now this is consolidating, finding a bottom in this range somewhere. When it's finished doing that, it's going to have another run and go even higher, is what we believe. We're in a multi-year bull market here. And then eventually it'll find a sort of a sideways band that'll follow. If you look back in the last big precious metal bull market, which started roughly 2003 and went to roughly 2014, silver had been in a band for a very long time, let's say a $4 to $7 range. $7 would have been a really high end. Then it ended up, after that run, exceeding old highs over $50 at that, and then consolidating back, and then finding a channel that we saw in the last 10 years, which is basically a $20 to $25 level. Now, after this bull run is over, it'll eventually find another level that's going to be much higher than we've seen before, and probably higher than we're trading right today. I expect it to be a good piece higher than this. That's our view.
About a year and a half ago, almost 2 years ago, when you were on my show, you had said that eventually silver's fundamentals would take it to $300. People thought you were joking, or maybe that was just sensational. Nobody was laughing at you anymore. After $100, sky's the limit. And actually, it ran up, like the introduction. In my introduction, I said that it ran up faster than most people expected, including yourself. When I spoke with you earlier in the year, you didn't expect it to go to $100 this soon. The fact that silver moves up so quickly, and I use the present tense because it's historically done that in the past. The fact that it just stays flat and then all of a sudden in a couple of months and in a very short amount of time moves up dramatically. Why is that? I mean, why is it that silver and gold, but mostly silver, has these huge swings up and down, and we don't think of it as a speculative asset like a tech stock or a crypto?
Well, yeah. You get there's a lot of volatility, especially now, more volatility than I remember in the last bull market. And lots of reasons for that. So obviously there was a lot of speculation jumped into the market, but the setup is on the macro, of course, and gold is the first go-to as a store of value. That's really its function. If you want to hold value, you hold gold. And there's been so much fiat currency and debt created in the last 25 years that it's not only held value, it's appreciated significantly. And silver does the same. It's the poor man's gold. It follows gold. And it is also has additional tension because of the industrial demand. So you've got this huge growing, significantly growing industrial demand for silver, then pile on top the monetary demand, and then pile on top the speculation, and you get these huge explosive moves.
Who usually drives up these explosive moves? In silver in particular? Is it the retail investment crowd, the institutions, industry, refiners, recyclers? Who are the main actors that move the price when it comes time to move the price?
I'd say it's a combination of everything. You even had, I think it was last fall, Russia central banks start to buy silver bullion. And then certainly a lot of institutional buying came in over the last 10 months, a lot of it. And you see that in the juniors. You see the amount of money that's come in to finance, well, not just the juniors, the mining sector, the miners, the developers, and the explorers. So a tremendous amount of money has come in to explore and develop these assets that we hadn't seen in 15 years, that kind of action. Probably never to this sort of magnitude. So certainly a lot of that has really driven up the price. And you get, on the macro, gold and silver represents such a small percentage of the value of the stock market in general. It's very, very small. So when generalist funds start to move into the sector, even with small amount, 1% weighting, for example, if they were to do that, and you're seeing major banks in the last several months calling for up to 30% weighting in bullion, precious metals. So that's huge. And I remember in the last bear market, which was about 1999, early 2000, Apple at that time had enough cash to buy all the gold mining companies on the board in cash. So it gives you perspective of how small the industry actually is. So when you start to see people wanting to not hedge, but get into an asset that's going to hold value when you've got all this devaluation of currencies, and combined with whatever macro is going on, yeah, you're going to have a lot of volatility and some really big moves.
How would you describe any changes to the mining industry in your business in particular now that silver is substantially much higher? So fundamentally, what is the difference now for a silver explorer or developer at silver at $70 or $65 an ounce versus $25, which is a couple of years ago, or $30, which was last fall, not that long ago?
Yeah, a couple of things. It makes some of the assets economic, like highly economic. La Seguera, that we just put the PEA out on, is a prime example. That's one thing. And for juniors like us, the other thing is we have access to capital. Where in the last 10 years, we're struggling just to get enough capital to keep advancing things a little bit, but never enough and never fast enough. You need capital to move quickly. And so a big change that way. These companies have lots of money now. The mining companies are making a lot of money, and they're going to have to deploy that. Some of them are buying back stock. There's some mergers going on. You're going to see a lot of that. So now they've got a lot of money to buy assets. And with Kootenay, we're sitting here with 4 deposits, and now a PEA on one deposit shows 14 years of mine production. We're very confident we're going to find a lot more ounces there, and then a whole pipeline coming right behind that. And with our Colombo project being drilled now, pushing it from 54 million ounces to 100 is the objective. So here you got one company, 4 projects, potentially a few decades of production profile for somebody. So the companies have a lot more money in their pocket. And for the juniors like us, and we're now transitioning from explorer to developer with the PEA, we've got the capital to move ahead confidently and do the job we need to do more quickly as well. So it's really changed the industry a lot. I mean, just the price move, more profit, more money in their pockets. And for companies like us who don't produce, the access to capital that we haven't seen for a very, very long time.
When a project becomes economically feasible, just explain to the investor what that means practically. Does that mean you're able to commence production sooner than expected?
Well, not all ounces are created equal. There's a whole combination of mining costs, capital build, what your recoveries are, what your grades are. It all goes into the profitability of the ounces you have. And so an increasing silver price makes ounces more profitable, whatever they're on. Not all ounces are created equally. And there's 3 series of economic studies we do with the deposit. Once you make a discovery and it gets to the stage where it needs these studies, the first is the preliminary economic assessment, PEA. That has a lot of detail into it. It goes into it, but not to the extent a feasibility does. So you got a PEA, then you have a pre-feasibility and a feasibility, and each step has more technical work done, de-risking the project and more detail and more accuracy into it. So the PEA is the first level, and generally a PEA can be plus or minus 30%. Now, we put a lot more work into our PEA, so we've got a lot of confidence into the cost assumptions that go into the financial model. And then when you get to pre-feasibility, it's more technical work. It may be on the technical side, or the geotech side, metallurgy, water. How much water do you have? You have to establish all these things, and then the costing. So there's a lot of inputs that have gone into the PEA on the cost, the cost of a mining fleet, or if you're leasing it, the cost of all the items that go into your plant, etc. Roads, infrastructure, everything. So you're doing a lot of costing there. And the pre-feasibility gets into more and more detail. You're getting real live hard quotes, so your accuracy is getting better. Confidence on the studies getting better. And you're doing other things to eliminate any risks or mitigate any other mining risks as you go. So by the time you get to a feasibility study, if it's showing the positive economics like we see in the PEA, then that's something that becomes bankable. Bankable meaning that banks, investors, funds are willing to give you the money to do the build because the return is on the capital is going to be there.
People have an understanding, some people have an understanding or perhaps misconception, maybe we can clear that up, that the mining sector has a lot of leverage over the price. So if the price goes up, and in the industries that want silver for chips or semiconductors or solar panels don't want $100 silver, they'll call you up and say, hey, Jim, can you make the price lower somehow? Is that how it works?
No, it works by supply and demand.
That's what I mean. You can just expand your supply.
Yeah.
Well, the reason it's $100 is because the mining companies have not expanded their supply. Can you comment on that?
No. Yeah. Well, okay. There's a fixed amount of any metal in the earth. You cannot create more than is here. And then you have to find it, and you have to find it in concentrations big enough to be economic, because there's a cost to extracting it. And then the price you get has to be greater than that cost of extracting it. Not only greater than the cost of extracting it, which is mining and processing and refining, but greater than the cost of extracting it, plus the reclamation, plus the capital build, and it's very capital intensive. You see, at 3 million We still here? You still there, David?
This adds some character to the
Yeah.
to the
We're
to
in
the video.
camp
It
here
adds
at
some
Columba.
authenticity. No, I like
Yeah.
it. Keep going. Okay.
The generator just went off. So I'm good. We're still
For
live.
those of us
Anyway.
watching, Jim is currently on site. This is as authentic as we can be without physically going to the site in Mexico. Okay, so yeah, keep going, Jim. You were talking about the the supply and demand fundamentals of
yeah. So in other words, it takes a lot of capital, and it takes a long time to go from a discovery to mining. 40 years ago, the average was 10 years. Now it's only expanded. It's become more difficult. The regulatory red tape has only increased, and it's becoming harder to find the deposits on top of it. So statistically, simple stats are somewhere around one mineral occurrence out of 2,000 makes an economic mine. So first of all, you got to go through 1,999 projects. And that takes a long time. It takes a long time to discover, drill. If you look at us, for example, on Columba, we've been at it for 6 years now. We just put out our first resource last year. That time frame was largely impacted because of the access to capital. We could only access just so much at a time. The market was pretty difficult. If it was now, we could accelerate it that time frame. So all the metal cycle impacts the time frame as well. And then when you go into a bull market, what happens is you don't have access to do exploration. So you're not even being able to have money to be looking anymore, or advancing your projects, or not enough money. So there's a very long timeline to replace the supply that's being mined.
Yeah.
And it's costing more and more all the time.
When you look at the fundamentals that drove the silver price to $100, are they still intact to drive the silver price to $300 and perhaps beyond? In other words, the drivers of much higher silver price, what are they today? And have they changed since a year and a half ago when you first made that call on my show?
Nothing's changed. The fundamentals are exactly the same. The only difference is that we've had a true breakout on the silver price in a very dramatic manner. Now it's consolidating, it's finding another bottom, and it's going to go again. And where it goes to is kind of anybody's guess. Because when it gets going, the speculation will come back in. But we're now in a changed price environment, in our opinion. Just go back to that last market where we touched on this already. In 2000, silver was around the $5 mark, $5. Ran to over 50, to over 10 times. But then eventually when it settled down, it found a channel sideways for a long time, say 18 to 25 roughly dollars. So that was your new channel off of five times, 4 times, 5 times. So now we've gone from this channel of 2025, 4 times, 5 times, that could be 80, 100, or even more, because the industrial demand is growing so much that it creates that real tension when the monetary demand and industrial demand hit each other at the same time. You get these explosive moves. So we're just had the first leg up on this silver bull market, consolidating. We'll have another and probably another. And at some point it'll settle down and we'll get a band for a number of years till fundamentals change again. But whatever that band is going to be, it's going to be much, much higher than it was historically.
So when silver does go up eventually, like it has throughout history, what happens to silver mining stocks? And my question in particular is, we know silver miners gain leverage to the stock price. That's why we buy silver mining stocks.
Yeah.
What do you as a CEO do to ensure this leverage? What are the strategies that any CEO like yourself would take to ensure that his stock stays attractive to investors, even though the underlying metal itself may already be very attractive?
Well, so what do you need? You need two things. First of all, you need a discovery. You need to actually have ounces in the ground. That's one thing. Resources. We've got 4 deposits, so we got one of the biggest resource bases of any junior company on the board. One of the largest. That's one thing. And then there's the quality of the ounces. So, how are they economic? What price are they economic, and what are the margins? So we're just beginning to show that now. So these are the steps we're taking. We've got the new discovery at Columba, which is at 54 million ounces. Big drill program to expand on that. So we're growing the ounces. That's one thing you can do. Concentrate on the quality of the ounces. So get your most economic ounces is what you want to concentrate on finding and developing. You got to start doing those studies to prove the economics. And now we've done that too with La Ciguera, the first study there. So those are the things in your control. Discovery, well, that's something you go out and do. I wouldn't say that's really in your control, because you have to look at a lot of projects before you get a discovery. So concentrate on things you can control. You can't control the price. Do all the technical things you need to do. Do all the proper studies you need to do, and take care of that. And then keep yourself as well financed. That's the other key. You don't want to be caught short when the market goes dry, which it'll do. Even in a bull market, access to capital can dry up for a period of several months, and so you want to keep ahead of that.
Let's talk about the recent drill results, and you said you entering a PEA, correct? So tell us about the changes at Columba and La Ciguera since we last spoke, which is a couple months ago.
Yeah.
And what the current milestones have been for 2026 so far.
So when we started 2026, it was Columba was the flagship, the drilling, a new discovery of a vein district, aggressive drilling program, expanded with financing in the end of February, expanded from 50,000 to 60,000 meters. We're halfway through that now. We put out a maiden resource of 54 million ounces, good widths and grade, 284 grams per ton, really good widths on these veins. It's classic veins. So that tells us that you get to enough size here, your mining costs could be pretty low. When you have wide veins, that's better. And tremendous upside, because all of the resource bodies in the veins that we had defined are open. We hadn't found the edges of any of them. So right now we're almost halfway through that program, and it's all gone into stepping out at roughly 100 meters at a time just to find the edges of what we already have. That portion's almost done, and then we'll be moving on to the next set of targets after that. So end of year into the beginning of next year, we'll be wrapping that program up and then have a resource update. And then we'll assess do we now have enough ounces to do a preliminary economic assessment at Columba. In the meanwhile, because that dramatic breakout in the silver price early in the year, late last year, we had 2.5-3 years ago, we had redone all the resource reports on the 3 other deposits we have, because they weren't economic at $25 or $30 silver, but we knew the silver market was coming and things were going to change. So we updated those reports to have those properties ready to move ahead. So La Ciguera was ready to move ahead in January, and we started that preliminary economic assessment on it. And we just put those results out. Really great. 14-year mine life. Beautiful. Producing 64 million payable ounces of silver. Production profile looks excellent. First 5 years, over 6 million ounces a year. We used a $50 silver price, which is a forward-looking consensus by banks. And
that's interesting, by the way, because a couple of months ago people were saying 30. But anyway,
that's how fast it's changed.
Yeah,
and some banks are much higher even. So that's what we use, and that gives us, using a 5% discount rate, $763 million US NPV after tax, and an after tax internal rate of return IRR of 41%. At spot, when we put the release out, spot that day, spot I think was 67. So at spot, the NPV goes up to 1.3 billion and the IRR to 64%. So you can see what the impact of increasing silver price right there. So basically what the study's telling us is you've got a project to build a mine on. And now you have to go to the next de-risking steps, do the additional technical work down that pre-feasibility, feasibility path. So the first thing we're doing, because this is a pit-constrained resource, it sits right at surface. There's two main zones to it with a gap in between. We're going to drill that gap off because it's got the potential to add 10 to 20 million more ounces with a pretty small drill program. That might cost you $3 million for the drill program. You could increase that many ounces. Well, then that would probably lead us to do a quick update on the PEA with new numbers. And then additional metallurgical work is recommended. Hydrology, which is how much water is there in the ground, how much pumping would you have to do you have water available for process, etc. So lots of technical things you knock down. And then start your permitting process. So that'll be the longest lead item here in Mexico. It's a very tricky thing at the moment, but definitely doable. So that's what's going to be happening at La Ceguera now. So it's gone from something that we had put on the shelf to a lead project along with Columba. And it changes the company a lot because now we've got from Explorer expanding at Columba, adding more ounces to, hey, we've got an economic study here showing something that could that shows that this deposit's very economic, very attractive looking at PA level. So now you're becoming a developer, not just an explorer. And those ounces are going to be valued a lot higher than simple ounces in the ground.
You said something earlier that $25, $30 an ounce wasn't economically feasible. And you also mentioned that there was a time when silver was trading at $5 an ounce. So what has changed in terms of cost factors for the mining industry the most over the last 20, 30 years?
Inflation.
Which let me rephrase my question. Which parts of the mining, and in particular the production process, have inflated the most? Energy, labor.
I'd have to say all of them.
Okay.
The capital cost is. I actually haven't looked at the percentages, but off the top of my head, I think the capital cost is probably the biggest one. So the capital build, certainly the production costs as well. So energy has gone up a lot. Wages have gone up, but they haven't kept pace. Everybody knows that. Just look at your bank account after you've paid your basic living expenses. You don't have as much as you had 20 years ago. So that hasn't. So that's probably the smallest increase. I'm going to say. The biggest, I think, is capital cost, but we actually haven't done that comparison. It'd be an interesting one to do.
Yeah, I'd be curious. I presume most of that would be construction materials and the labor around that.
And just the cost. So that one thing that surprised me a little bit, I wasn't real surprised because I had a feeling it would be the capital cost of this La Ceguera project is $332 million. And the guys did a really great job of costing that. So we're pretty confident on that number. But we'd had some internal studies that aren't that old that were about 90 million less not too long ago. We felt that maybe that study was a little light at the time. So 10 years ago, you probably would have been 50% of this, or 60%, let's say 60.
And I asked this following question to a lot of the juniors I talked to that's transitioning to a developer. How does one finance a $320 million project without diluting the share price?
Well, you're going to have dilution of some kind, and that impacts your return. There's no way around it. So you start down that path. You're doing additional studies. If we add more, we spend money that's going to add the most value right now. If we can add 10 or 20 million more ounces right in the same spot, you're already mining that rock and it's being given zero value. Well, if you're recovering silver out of that now and making money, that's going to increase your value, your share price, lower the dilution. So increase your share price, obvious. When you get to the pre-fees or feasibility and start have an instrument where you can start to raise money, then you have to start to balance, okay, do we issue equity or do we look to debt? And you always have to be careful about debt because debt comes with a lot of hooks. And debt sinks a lot of companies when they start out building. Because if you get any setbacks on your build or your initial production, there's always bugs to work through when you have a new plant. And you have a finance hammer over your head that could be very damaging. We've seen that. Of course, high silver prices helps that a lot. So, but you're going to have to make these assessments as you go on trade-off studies of what the best is to do. The other thing is you can choose to dilute the project and not the company. So you can bring a partner in.
Oh, yes.
Bring a partner in to provide the capital for the build.
Yeah.
Then you're diluting the interest in the project. So all these things you have to assess as to just a trade-off of what would be better and also the risks involved. So
yeah,
when you're a junior company, you don't have a mining company yet. You don't have the mining expertise. So maybe you bring in a mining company to mitigate the experience. They know how to do it. They've got the staff to do it already.
Right. I suppose my last question, there are many ways to get a junior into production. The most common way that investors are expecting is just to sell the asset. Yeah. But if we were to just take that out of the equation, explore other avenues for now, a JV, for example, maybe a leasing agreement with the producer to take ounces out, or a royalty agreement. What makes the most sense to you? Because, like you said, juniors typically don't have expertise to take the mines out of the ground themselves. What do they do next?
An outright takeout of the company is quite a viable option. That's the most common for a junior. A JV, also a good option. If you can get a JV where somebody comes in and builds everything and starts mining and spends all the money to do that, you don't have to raise any more money.
In that scenario, how much of the mineral rights does the other partner usually retain?
Well, it's a negotiation. So they're negotiating to retain the most they can. And the way you evaluate that is, okay, what's the value, what they're bringing in, how much money, and what dilution would it take for the company to get to that same spot? And so then per share at the end of the day, let's say you did a JV and you go into production. So cash flow per share, what is it with a JV versus what is it if you would have gone out and had to do some equity plus some debt? Some combinations. Usually what if a junior goes to production, it's generally going to be a combination of equity and debt somehow. And the debt, the debt has a cost to it too, because now a lot of the cash flow might be going to the debt servicing. So you have to evaluate that as well.
Why can't the junior, in theory, raise capital, hire the people who have experience as operators, and then just do it themselves?
Well, you can. Yeah. And juniors have done that. And juniors have done it successfully and unsuccessfully. So, and our board, we've got the experience of doing that. Our chairman's done that 8 years ago, put an open pit mine into production in Mexico. And then myself, going back 25 years ago, we helping as a president run an underground mine in Mexico. And then was part of the founding of Alamos Gold way back in 2003 when we did the merger on the Mulatos asset. And I sat on the board, and not as an executive, I was just on the board there watching that build. So we know we've done it. We know how to do it, and you can do it well. So we're just setting everything up so that eventuality could happen. My expectation is with this asset and all the assets we have, that a mining company is really going to want what we have here in this environment.
Yeah, tell us about the next milestones that we can look forward to and where we can keep up to date with Kootenay Silver.
Yeah, so the La Seguera PA is out. There will be a drill program starting in the fall on that gap zone. We hope to be adding a bunch of ounces in there. So that'll be what's happening there. Then there's going to be a bunch of boring stuff for the investors, hydrologic studies and geotech studies and things like that going along with it, and some metallurgical optimization. At Columba, the drilling program continues. Once we finish the step-out drilling on what we call the D vein, where 60% of the ounces of the resource currently are, we'll have some more drill results coming out. We're nearly ending that program, a step-out, finding the edges. We really haven't found all the edges yet, but we'll be starting to move on to other veins that are lightly drilled or undrilled. And so we're roughly halfway through that big drill program. So we'll be batching up drilling, putting that out. Then coming into the end of the year, beginning of the next year, there'll be a resource update on Columba. And then we'll be making a decision about either more drilling there or PEA or a combination of both.
We'll put the link down below to the company's website, so do make sure to check it out. Do your own due diligence in the stock. The ticker is KTN on the TSX Venture Exchange. Welcome back, Jim. It's good to see you, and we'll speak to you again soon. Take care for now.
Yeah, thanks a lot. Bye.
Thank you for watching. Don't forget to like and subscribe.